Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. She's a former managing director at Goldman Sachs and Bear Stearns. She worked on Wall Street for a long time before she became a whistleblower. She's the author of her two most recent books are All the President's Bankers, and her new book, which she's here to talk about today, is Collusion: How Central Bankers Rig the World. Nomi Prins, thank you for joining me again.
Thank you so much, Jason.
Now, Nomi, we had a conversation for a couple hours about the markets a couple months ago, and one of the things I asked you then is something I want to ask you, now to share with the listeners, is how often do you think, based on your research for this book that you're putting out, that's coming out soon that our listeners can pre-order, how often do you think these central bankers coordinate or collude to manipulate or intervene in different markets?
That's a really good question, and it really depends on their, I believe, fear factor at that moment. So, for example, when the financial crisis first hit in 2008, that collusion was immediate. Swap lines were opened up immediately. A coordinated effort to ensure there was, flow of dollars into the system was enacted immediately. That's not necessarily different from some historical moments where that happened, but the epic size, which started then and which has increased since then, is historically high. But also they continue to monitor what happens with markets. They continue to monitor what happens in their own domestic markets as well as on the international markets. And so when there is an activity, let's say, a small interest rate hike from the Federal Reserve, and the markets don't like it, and there's more and more volatility introduced, and what happens is other central banks will come in and sort of act as mitigators of that impact. So if the Fed raises rates a little bit, the ECB, the European Central Bank, will come in and decide to buy more corporate bonds, or the Bank of Japan will verify publicly they are not changing their monetary policy, and in fact will go and buy Japanese ETFs. And so there's specific phone calls and documents and discussions, and then there's also these adjustments that happen relative to market movements.
So you think basically then now it's gotten to the point where they're so worried about contagion and maybe risk of a bank failure, European banks or whatever, there's so many, I call them economic landmines at this point, that are over $1 trillion in size. You think now that central banks are willing to trade many different markets almost all the time or all the time now?
Well, I think they are. I think they have been. I think that fear factor has increased, because at first there was a fear factor from a legitimate financial crisis, a legitimate emergency. And when I say legitimate, I don't mean that it should have been caused, but that you could actually point to. There was a definite liquidity crunch in the U.S. banking system. They had definite contacts and derivatives throughout the world. The assets that had been created and leveraged from the United States were proliferated and sold throughout the world. So there was a serious contagion already in process, and so the policies that were put in place that fall in 2008 and a few years after that were specifically to kind of readjust the markets from the standpoint of what the central bankers thought they needed to do. Bring rates down to zero, flood the system with money, buy bonds, buy mortgage bonds, and ultimately, again, buy corporate bonds and ETFs throughout the world. That was something that was in reaction to an emergency. What's happened since then, over this decade and more recently, is that the emergencies, like new emergencies, have been baked into the markets. So by virtue of the actions of these central banks to create these asset bubbles, because of that process to begin with, we've gotten to a point where those asset bubbles themselves, whether in stocks or bonds or public bonds, corporate bonds, etc., are their own danger. And so now what happens is the fear factor of basically their own policies coming to wreck the markets, as opposed to the initial statement of why those policies were enacted to begin with, which was to help them, is now also imperiled. And so they don't really have a plan B to sort of reduce this, the danger they've inflicted on the markets. They don't say it's their fault, but the reality is there's been $21 trillion of effectively electronic money created that is then leveraged, that has kept these markets where they are. And any clawback on that creates additional volatility and creates fear in them that all of this work, quote, that they have done will be for naught.
So during your travels for researching this book, I know I listened to another interview you did about the book recently. You said you went down to Brazil and you spoke with a Brazilian central banker, and this central banker told you that he thinks the Federal Reserve and these other central banks are trapped, meaning that they can't meaningfully reduce their balance sheets, they can't meaningfully allow interest rates to rise. Do you agree with this central banker's assessment of where the global economy and these 5 or 6 large central banks are now?
Yes, I do, and he actually he was the head of research at the central bank in Brazil, who had done a lot of analysis numerically as well on just the impact of these policies on markets. So, for example, if this much of an asset buying program has been enacted by this particular central bank, the market has reacted by rising by so much and so forth. We saw a strong correlation, as actually does some of the Federal Reserve's own reports, not that they report for that basis of a correlation between like how markets pop up versus how much quantitative easing or bond buying has been done. And so when you look at that having been the cause and effect of where we are now, if the central banks, the major ones, and we're talking about predominantly the G7, but really, the Fed, the ECB, the Bank of Japan, the People's Bank of China has a sort of different MO, but it's kind of on the outside of that. But the real G7 central banks, they can't really get out of this program because to get out of the program means to really crash the markets that they've elevated. And so particularly the bond markets, if they were to dump, for example, the Federal Reserve has $4.5 trillion assets on its balance sheet, a combination of treasury bonds, so U.S. public debt, and mortgage bonds that it bought from the private banks when they were in trouble at the beginning of the financial crisis, which they still are holding. If they were to dump $4.5 trillion of bonds into the market, it will cause mass chaos, not simply because all of a sudden there's this extra debt floating around the market, and so that lowers the value of the debt that's already out there, but also because it's just a very big number. So what they've said, what central banks have said in different ways, and what they do, which is slightly different, is to say, well, they'll taper, they'll sell a little bit. But the reality is every time they do anything remotely like that, we're talking about tiny, tiny marginal increments anyway, the market gets upset. Now, the bond market blows up just a little bit, and the stock market goes down just a little bit or a lot, depending on the day and depending if there's other, news items or other types of factors that also create volatility amongst themselves. And so they are caught in this, this sort of Frankenstein financial situation of their own making.
It seems to me like Ben Bernanke, first of all, a long time ago in his helicopter speech, his goals were to not end up like Japan. And it seems like all these central banks, the large ones that you mentioned, including the People's Bank of China, the best case scenario for a lot of these large central banks is Japan, where there's not a total collapse, but there's stagnation, I would say, worsening stagflation.
Right. And Japan, in fact, has become more like Japan than it was to begin with when Ben Bernanke said he didn't want the United States to become like Japan, which he did in a speech where he was effectively unveiling another element of cheap money policy or, another element of quantitative easing at the time to say, look, we're doing what Japan did, but we're not Japan. The result, though, is that over this decade, we have had rates about as low as they had been in Japan. Japan has reduced rates most recently, last couple of years, to negative, from having had them close to zero already, which they've had for quite some time. And so the entire globe, or at least the sort of major central banks of the globe, have basically kept the price of money at zero. So not only has what Ben Bernanke said been off, because and it's not even a question of stagflation. I mean, we do have low inflation, that's true, except in the markets, except in the cost of living. There are elements of inflation all over the place, but in terms of sort of general economic, classical measures of inflation, things have been quite low. That's true, and they will continue to be low. And in Japan, they're really low. In Europe, they're low. So we've had a situation where there's been this influx of money into the system, which has helped the markets, but has not helped the sort of grassroots economies, Main Street economies, and yet we can, because there's no exit plan and there's no real exit option, we're going to continue like this, I think, for at least another decade or whatever. I mean, almost the years don't matter, but this policy can't really be unwound in a meaningful way.
Well, they're going to continue
without hurting a lot of people in a lot of economies.
Yeah, I agree. Plus, Trump's ramping up a trade war. There's going to be with China. There's going to be a lot of collateral damage with that. But, I think they are going to, I agree with you. I think they are going to continue to do this as long as they can get away with this. I just not sure I see them getting away with this for another 10 years before there's another crisis.
Well, okay, so that's the thing. The crisis can occur at any time. Their policy to quote, fix or deal with or mitigate a financial crisis would be sort of to do more of what they're doing because they don't have another plan. They don't have anything else to do. So, for example, the Federal Reserve's raised rates now by 1.5 points in the last 2.5 years, which is really not that much, but it was all they could do. All they could do without causing sort of massive wobbles in the markets, and not just in the U.S., but globally because of all the codependencies, is that, they can do 25 basis point increments, which is tiny, but that's what they did. And then occasionally along the way, that would have a negative market impact. And again, other central banks would step in and balance out the global cost of money. I think they would continue to do that. So if we had another financial crisis, which I believe is absolutely a possibility in way nearer than 10 years. I mentioned that in terms of just what they can continue to do, not that it will necessarily help. But if we have a financial crisis in the near term, then all the Fed can do, and I believe they're setting themselves up to be able to do this, and we can talk about that. All the Fed would be able to do is say, okay, we'll take rates from a 1.5 points down to 0 again, and we'll increase our balance sheet from $4.5 trillion to whatever, right? Because they'll just continue to do what they've done, because from their perspective, optically, it looks like the markets are higher. Sure, we have a major overhang of debt in the private sector and in the public sector all over the world, but it looks like things are okay. So they believe they've been effective, even though they're afraid of what could happen if things fall apart.
Yeah, I mean, Ben Bernanke was named Times Man of the Year for just printing tens of trillions of dollars in liquidity, doing the currency swaps, like you said earlier, tens of trillions of dollars in almost essentially interest-free loans to foreign corporations, foreign governments, foreign central banks. One more question, though, on your trip to Brazil. So with your discussions there, boots on the ground, and also with the Brazilian central banker, did you get a sense that this policy from these larger central banks with the more established economies is really hurting emerging markets?
That's a good question too. Yeah, and I think it hurt some of these emerging economies for two reasons. One is because when the major central banks, as they were doing, are cutting the cost of money down to 0 and supplying basically the private sector, the private banking sector, whether it's international or domestic, with all this 0 cost money, which then gets leveraged back into the markets. It looks good on the outside for those bigger countries. The smaller countries have to deal with actual real inflation. So the smaller, not the Brazil small, but the emerging countries have to deal with actual rises in inflation because of where they are in the economic hierarchy. So they have a real situation where they can't reduce rates to the extent that a Fed can, because they actually have to deal with the real cost of food, so the real cost of utilities. They have to deal with the real difference between the wages of their countries with the inflation that ultimately comes in if they were to follow a similar policy to larger countries. And so, but at the same time, larger countries don't really want the outflow of their currency and their investments to go too much away from the core countries, these larger countries, into the emerging market countries. It's okay as a smaller investment, as a foreign direct investment at a certain point, but if it gets too big, it concerns the U.S. I mean, it creates trade wars. It creates all these sort of other impacts that can happen. So if you're Brazil and you're facing, which Brazil was, really high inflation during a number of these years within this decade, you can't really do what the U.S. is doing, but you're expected to do what the U.S. is doing. So there's a political expectation that the central banks reduce rates in the same manner and follow the leaders of the major countries. But then there's the domestic problems that happen when rates are reduced too much and inflation goes up for the real population in these countries. So they're really caught. Mexico had this as well to a lesser extent. They're really caught in the sort of crossfire of fabricated monetary policy from the bigger central banks with dealing with the realities of their own economies.
And Brazil has had a long history of corruption. There was the Petrobras scandal. I think one of their former presidents is about to go to prison for a long time. And the history of Brazil, I think they've had a bunch of hyperinflations in the last 40 years. So bond markets, they don't have the leeway that the world reserve currency, the U.S. dollar, is given.
That's right, and they also don't have the buy demand. I mean, to an extent, the fact that the dollar is the global currency or the main global reserve currency also means that the U.S. can manufacture debt, which we do, and there's a necessity of central banks and banks around the world to purchase that debt. There isn't that same necessity to purchase, Brazilian bonds, and so there's also this hierarchy of just supply and demand that happens that allows the larger central banks to be more more collusive on the sort of basis of their policies, but also to know that the debt that's created, as well as the reserve currency that's required by bigger and smaller central banks around the world, will continue to give a bid to this debt. So they're kind of protected in a way that Brazil is. And of course, yes, Brazil's had a lot of other corruption there. President Lula's just been given a prison sentence. Interestingly, and I go through this in the book, the current, well, actually, he's moving over from the Ministry of Finance under the interim government right now. Henrique Moraes looking at running for possibly president of Brazil. And this is a guy who had been the head of the central bank during Lula's term, during the ex-president's term now, who he's now been given this corruption-related jail sentence. And he's also the current Minister of Finance, and he's looking to run for president. So the interesting thing about Brazil is these people kind of recycle through roles depending on, sort of what other people don't get away with and what people do get away with along the way.
Yeah, it's interesting to see people go to prison in Brazil for corruption, and here in the U.S. it just doesn't happen very often for banking executives committing fraud or corrupt politicians on both sides of the aisle. I know you're frustrated with that as well as I am.
Exactly. You mentioned, Petrobras, which is a big oil company in Brazil, which had a tremendous amount of scandals around it. It was tied, along with other companies in Brazil, to politicians on all sides of the political spectrum in Brazil, and various politicians were, indicted, thrown in jail, et cetera, along the way. And yes, that doesn't happen here because we call it lobbying. Like we have a situation here where, this is a legalized form of corruption, and it's okay. And every so often, there's like a sex crime or something that really doesn't have to do with the sort of financial corruption that's inherent in our political system, and that sort of gets, possibly people resign over that sort of thing, but not necessarily over this sort of regular connection between corporate lobbyists and politicians and so forth. And this goes on up through presidents and through or through past the secretaries of state. This is something that happens on both sides of our aisle, where there are illegitimate business interests, connections between the power one has in a public office position over their private portfolio, over their private businesses, or their private ability to make profits at a later stage. So whether they're in office or whether they're out of office, this kind of corruption is really inherent in our political system, but it doesn't have the same elevation to getting punished as some of these other countries.
Yeah, it's a swamp full of a lot of different swamp creatures, and they really don't want to see any change. So every time a populist candidate on either party or an independent comes to D.C. promising change, very little of that change gets enacted. I mean, I've lived outside of Washington, D.C. now for almost 20 years, and I've seen tons of change candidates come here, and they all end up either compromising or quitting or getting, kicked out for whatever reason, and no real change happens. So let's transition now to China. So in your book, in your opinion, based on your research with this central bank collusion, do you think the People's Bank of China is being included in the collusion, or do you think that like the Bank of Japan, the European Central Bank, the Bank of England, the Federal Reserve are mostly working with each other and coordinating, and it's kind of versus China, or do you think China's involved and they have like a legitimate seat at the table now involved in these discussions?
In the beginning of the crisis period, China was pretty much left out, and they were left out because their markets were not as interconnected. They weren't as interconnected geopolitically, and so forth. So there are reasons why they weren't involved. They're not in the G7. There are reasons that they were not involved in the initial collusion to save the markets, save, quote, the economy, but really the markets from what mostly the U.S. banks and some European banks had done to everybody. And along the way, China went from kind of being critical of, and publicly critical of, what the Fed in particular was doing by over the years, and saying that, you know, their process, their asset buying, their rendering money so cheap is going to ultimately cause some real problems. It wasn't just China that said this. I mean, Mexico said this. A number of countries who had seen this sort of situation in smaller measures over the years had said it. But China was very vocal about their concerns for another financial crisis after the first one happened. And their policies were enacted in a sort of different way, in that they kind of did their own version of quantitative easing, but it was more like fueling the debt of themselves domestically. So it was very much about sort of connecting the policies of the government itself with helping the state-owned enterprises and other institutions within China that would enact those policies. So, for example, what China did, and what the People's Bank of China did, is sort of provide cheap funding in a way. I mean, we've provided it for speculation in the Fed's case, but they provided it for companies to sort of build infrastructure, to sort of build high-speed railways, to build roads, to build sort of cities in the middle of nowhere and so forth. Well, not nowhere, it's China, but I mean in sort of areas where it wasn't as populated, and sort of grow also their partnerships with countries around the region and outside of the region. So during this last 10 years, China would fund, for example, some of its institutions to work with institutions in Brazil, or create, different sort of partnerships that they hadn't had before. So their way of utilizing sort of cheap money policies, or the central bank acting as a financier for other processes is different in terms of its strategy, in that it's connected to sort of strategic development and trading partner growth and infrastructure growth type of financing. So in that respect, they did copy ultimately some of the policies of the main central banks, but they kind of did it for their own growth benefit. And so, yes, they were excluded from a number of the main collusive policies of the major central banks. That said, they also have more trade agreements now with some of those central banks and some of those countries on the outside as a result of the ramifications of these policies.
Yeah, I was going to add to your points there that China has a huge credit bubble now. It's internal. They had $4 trillion in trade surplus, foreign exchange reserves, I think about 10 years ago. They had a lot less debt 10 years ago, and they've gone on this enormous spending spree with debt. So I think they're in worse shape from a credit and debt standpoint now than they were 10 years ago. But there's all these people, I'm sure you've heard this, Nomi, in the alternative media and the gold community saying that China wants a gold standard. China's going to, dump the dollar, destroy the global financial system and start a new system. That's not what I see out of the behavior of the people running things at the People's Bank of China and elsewhere. It seems to me that they want to join. They want a big seat at the table in that G7. They want to join with the Federal Reserve. They want to have like a really large say in either the next global financial system after the crisis, or reforming the next global financial system.
Yeah, I mean, I don't think those two things are incompatible. I think there's an element of timing. So I agree that one of the things that the People's Bank of China did during this 10-year post-financial crisis period, or sort of collusive period on a central bank basis, is that they've gotten, to an extent, a couple of new seats at the table. I mean, they're certainly a greater economic superpower than they had been 10 years ago. And yes, they have been growing along the way, but the acceleration in the comparative growth and the comparative connections to other countries in their purview has accelerated during this period of time. They have gotten their currency into the IMF's currency basket, into the special drawing rights basket, and that's historic, simply because until the last couple of years when that happened, they hadn't had a position with respect to this major kind of multinational central banky entity, the IMF, that was really created in the wake of World War II to be sort of a European-U.S. kind of thing. And so they were able to get in there from the standpoint of a currency. They have created trade agreements and currency relationships with other countries whereby things that weren't historically traded in ren, or they were historically traded in either dollars or petrodollars or something else, now have the ability to be traded in ren. That hasn't had a speedy growth in terms of the amount of trade that happens in ren. It's still very much a dollar-based, euro-based, yen-based kind of world, but those are steps along the way. So I think China's being very strategic in terms of, okay, what do we need to do? We need to grow our economy. We need to grow our trade relationships. We need to have better trade relationships with former U.S. partners or current U.S. partners, and sort of chip away at that to help develop our reach in the world. We need our currency to be in the IMF currency basis. Okay, we did that. We need to have our financial markets more open to foreign money, which will be a problem, actually. I mean, because you're going to run up against sort of the old mentality of China and the new sort of more open mentality of China. But ultimately, I think there's a knowledge that somehow, in order to compete, you have to be in the game. And so ultimately, their goal might be to have the ren be the reserve currency of the world, instead of the U.S. dollar being, and that every single financial crisis presents another opportunity to sort of step into that space. But there's also the fact that the U.S. dollar is pretty entrenched, and these things will take time. So from the standpoint of the gold community, I mean, there are reasons to believe, and certainly China's also very involved in purchasing gold from the standpoint of the central bank and so forth, because that's a way to chip away at the dollar supremacy. It's a way to sort of counterbalance with using some other mechanism rather than the U.S. dollar being the main reserve currency, to sort of balance trade and economies and interactions throughout the world. But those things, again, they all take time.
And I think also, there's a distinction between accumulating gold for your reserves and wanting to go on a gold standard. So if China goes on a gold standard, they can't do bailouts of their state-owned enterprises. They can't devalue their currency anymore on a credit bubble. The other thing, and this is why I think it's going to take a long time if China wants the RMB as a world reserve currency, they don't have a bond market to function for trading partners to reinvest reserves, and they also have capital controls. So I don't really, with large, strict capital controls, you can't really have a functioning world reserve currency. So I think they just, for right now at least, maybe for the next couple of years or through and after the next global financial crisis, they just want a larger seat at the table. I don't think they should have been allowed by the technical bylaws to get into the SDR. Because they didn't have all the qualifications, but they were granted it anyway. So they're getting a seat at the table, and I think that's what they cared about most. But China had their credit bubble is so large, Nomi. I don't think that they can go on a gold standard, because once you go on a gold standard, basically the central banker's ability to do currency devaluations, to do mass amounts of bailouts, that's taken away.
Well, that is true. I mean, that's the major reason why, for example, Ben Bernanke, when he's at the Fed, and all the Fed leaders that we've had have been so negative on the idea of a gold standard, because if one did have that, yes, it would take away from the ability to sort of finance whatever you need to do, whether that's an emergency, whether it's speculation, whether it's your friends, or whether it's infrastructure growth in case of China. But by and that's what that is under the assumption of there being a path to an actual full-on gold standard. However, if you actually add gold to something like a basket, or gold becomes a one sort of element of other currencies along the way, that is a way to mitigate or sort of diversify away from some of the concentration that any one currency could have, or that the dollar could have. So from the standpoint of China, going to a full gold standard, you're right, that would mitigate its possibility to use its central bank to do what it needs to do, and to sort of, which is what all these central banks are doing in the larger countries, which is basically finance either growth or the appearance of growth, however you measure it. However, they can still advocate to have an element of a sort of new way to look at a gold standard, just having a gold measure be one of the slices of reserves, such that by adding it, you're reducing the sort of percentage potentially of other currencies. So there's just it's not a black and white, all or nothing kind of strategy. You can add gold into the mix without fully going to a gold standard, and fully going to a gold standard will be something that all these central banks would be negative on doing.
I hope you're enjoying our interview with Nomi Prins. We'll be right back after a word from our sponsor.
Do you work out routinely and eat healthy almost all the time? If you eat paleo or vegan or work out routinely, you may be eligible to save up to 33% off on your life insurance thanks to Health IQ. Health IQ is a venture capital-backed, big data technology life insurance company that offers customers life insurance at special rates by using the latest technologies. For more information, please go to healthiq.com/WS4MS. That's healthiq.com/WS4MS. Yeah, I was going to bring that up, that I don't think voluntarily we're going to see these central bankers want to go on even a partial gold standard. I mean, that was attempted from my research in financial history after World War I with the gold exchange standard, where you could have reserves in dollars, British pounds, or gold. You had the option of all three. And so, is that where you think we're going to go, that the elites want the SDR with some type of gold component? What's your opinion on what you think the dollar? Do you think then the dollar is eventually going to lose the world reserve, the sole world reserve currency, and it's going to go to some type of basket then?
Well, again, I think that could happen, but that would be also a byproduct of more financial crises being invoked by the United States banking system, by what's going on, and also what happens with respect to trade and what happens with respect to sort of growth, real economic growth in countries and their relationships with each other. So it's not simply a weakening of the U.S. and the dollar from the standpoint of an immediate basis. It's a situation where the dollar is weakened because of policies that are inherently unstable with respect to its financial system, U.S. financial system, to sort of subsidizing banks versus, sort of helping the economy, for all the things that are detrimental to any global power, and then other powers coming into play and sort of taking away that sort of reign. And I think that's a potential scenario over time, and over multiple financial crises. And again, I do see another financial crisis coming because we haven't changed any or mitigated any of the factors that created the last one. We just have more debt and more cheap money and fake money in the system. So it's not an impossibility. I think it's just going to require a number of those things to happen over time, and other countries or other economies to take the place of the U.S. The trade wars that could happen could also be a factor in that. Geopolitics could be a factor in that, and time could be a factor in that, plus crises. So I think it's a possibility. It's not one of these things. Again, it's not binary. It's not like it's going to happen tomorrow. It's an evolution into that, in which case the dollar does lose its reserve currency status because it loses its proportion of reserves in central banks that are held in order to basically hedge or move currency and exchange values relative to domestic economies and the position of each country in the global economy. So there's factors in this that could occur over time.
Yeah, there's a lot of moving parts to this, and there's stuff that's just going on behind the scenes. I mean, without the one-time partial audit that Ron Paul got with both houses of Congress, Bernie Sanders on the left, and even a few Republicans agreeing to the one-time partial audit of the Federal Reserve, we wouldn't have even known about those currency swaps that were given.
And all of the loans, exactly, and all the trillions of dollars of loans that were given into the banking system. I mean, I think it's unfortunate. All these central banks, I mean, for the most part, there are reports that they put out on their various websites and that come out as well in terms of when they talk about rate changes and so forth. But we don't really know without those kinds of audits where some of the stuff is going. I mean, the ECB, for example, has a list of some of the entities to which its money goes, but you don't kind of know how it gets distributed, where it goes from there, and so forth. So there's a lot of missing information in these central bank entities, and that's by design. And unless, there are people that come up, and it is in that situation, and it could be something that comes from both parties. I should think any party, whether you're conservative or liberal or independent or libertarian, you should want to know how this massive amount of sort of non-free market funding is impacting the economy and the market system that people participate in. And I think it's important to do that. I don't see anybody, for example, though, in Congress right now. Bernie Sanders is certainly still there, but I don't see a lot of credence being given to even acknowledging that the Fed has actually really destabilized markets by choosing the policies it did and it requiring effectively or colluding with other central banks to do that around the world. I don't think there's a strong enough fear of what could happen in the unwind of that throughout both parties in Washington.
Yeah, I agree with that. I would like to see more transparency from the Federal Reserve, but I think, unfortunately, it's probably going to take another crisis and more regular, everyday Americans to wake up and write to their congressmen and demand it, because that's basically the only reason we got the partial audit of the Federal Reserve in 2008, because the pitchforks were almost out. It woke up people like me. I know you've been whistleblowing and talking about the problems with the banks for a long time. In your opinion, since you have more experience than me in the financial industry, is this the worst period you've seen in terms of rules changes, where you think you know the markets and the rules, and then, all of a sudden, basically without telling anyone, either a central bank or a Treasury Department or, I don't know, lobbyists for people in a certain industry get the rules changed?
Well, I think it's the worst period in terms of the artificiality of it, in that there's this kind of lull, and it happened under the last administration. It's happening under this one with regard to the Federal Reserve, that it sort of handled a financial crisis well, and as a result, the banks are doing fine, the stock markets are up. Yes, we have a ton of debt everywhere, but more than sort of ever, but it's manageable. And there's this just really scary kind of sort of pacifying of people and these entities over what could actually go wrong. But yet we're starting from like a more dangerous position. It's like we're not starting from like a hill, we're starting from like a cliff in terms of the amount of cheap funding that has puffed up these markets and has created all of these debt bubbles. We're at very, very high absolute levels of everything based on the policies the central banks have enacted, and there's just not a lot of discussion. Certainly not in the mainstream media, and again, not really in Washington, and not through the last Democrat or this Republican administration, and through Obama, through President Trump, as to how that could potentially be a problem, or why it's already a problem, why it's just simply realigned what markets do and taken more money into them relative to the main economy, and how that is an actual problem.
Nomi, I think that the debt problem is only manageable, and I'm using air quotes for manageable, because all these major central banks have manipulated the interest rates down, so their interest payments are actually the same size or lower than 10 or 15 years ago when interest rates were higher, so that's allowed them to grow their debt. But, the interest rates at the levels they are, maybe they're going to manipulate markets more. Maybe they're going to continue to buy more assets. Look how large the Swiss National Bank has grown. They've created basically a hedge fund running the Euro peg that they did for 4 years. And now it's the shares publicly traded for the Swiss National Bank have gone parabolic recently. It's just insane with their investments in tech stocks and elsewhere. But, I think this system is not sustainable, because now we're at a point where President Trump is going to be running with supply side economics. They did not cut government spending. And with the private sector tax cuts, there's going to be $1.2 trillion budget deficits or larger going forward. Treasury might have to raise $1.8 trillion in the next 12 months or something like that. And they're supposed to, in addition to that, they're supposed to raise interest rates and then also reduce their balance sheet. All these factors, something eventually, and I think that the key thing is to not give an exact timing on this, because there's so many moving parts and the rules can change. Something's going to break. Okay, I mean, they've been spinning. I think the analogy, is the circus performer who spins plates, right? And eventually, at some point, they spin too many plates, and the plates start to break. And I think that's what's going to eventually happen.
Yeah, I think that's a really good summary of what is going on and what can happen from it. It's the same thing like you're sitting at a blackjack table and you just lost a hand, and you're like, okay, well, what about, my friend over there, and what about like his mom, and what about my dad, and what about my cousin Bob, and you're going through, you're sort of borrowing money because you're going to hit the right hand, and you're playing, you're keeping the game going, but at some point, not only are you potentially going to completely be out with no one else to borrow from, or no ability to get it, and so will the other people sitting around the table with you. And that's sort of the idea of it as well, that if So our deficit can continue to increase. And if we're paying almost, sort of zero or very close to 0, 1%, whatever on some of the debt, then that's manageable. But yes, if rates were to rise, that would make the cost that much higher, which would mean we would have to incur that much debt to make up for it, which would then also potentially have the impact of raising rates a little just because our debt is worth less because there's more of it. But then you have a situation where the Fed can step in and say, you know what, maybe things aren't so great, we need to cut rates again. And then sort of the whole balloon has another sort of moment of inflation, like helium inflation into it from these policies. But yes, that can't last forever. It's not a way to run a country. It's not a way to run debt. It's not a way to grow the real economy or people's ability to participate in it. And it's not even a way to keep the markets up, because at some point, this sort of miss out, sort of this dichotomy of like our stock looks good because we as a company have bought billions of dollars of it because we borrowed money to do that, versus how we're actually performing, starts to really ripple through many of the companies throughout our stock market and other stock markets, and that becomes another plate that can fall, to use your analogy.
And most importantly, all this central bank intervention, Nomi, with the tens of trillions, is created even larger wealth disparity. And the people who are wealthier now from 10 years ago, post-2008 financial crisis, a lot of them didn't build a business. They just they didn't create more value for society. They didn't create new jobs or new products or services, like in a free market, how value is created. Instead, they got lucky because a central banker in one of the major economies made it so their stock portfolio, their bond portfolio, and their real estate holdings didn't crash. They've gone up and up and up and up.
Right. So it's paper gains, and I mean, if any of these people take out their gains and sort of use it for other purposes, then they can be realized. But a lot of that isn't necessarily what happens, because of that availability of cheap money is still coming into the system, into the hands of the larger sort of financial players and their clients and the hedge funds and private equity funds and so forth that can get into that, that can tap into that more easily than sort of real people or sort of a person in the street, and that does create inherent inequality, because that just means that the sort of process of money creation going into those that are simply using it for speculative purposes and not for productive or real growth-oriented sort of activities continues to escalate until it can't. But in the meantime, it creates more inequality from those that are participating in that process and those that can't. And that's not just on a individual basis within each country. That also happens between countries. That's the issue with Southern Europe, for example, versus sort of core Europe. That's the issue of some of the sort of the emerging economies or developing countries versus the main economies. Is that it also looks bad on a sort of country to country basis, as well as on a individual person in a country versus the number of billionaires or so forth in the country or in the world.
And I blame central banks for the majority of these problems.
Yeah.
And in my opinion, Naomi, I don't think central banks are free market, and I don't think they're capitalism. I think they're central planning. I think they create larger government. They pick winners and losers. They create more corruption. It's just a vicious cycle of wealth disparity increasing, more corruption. So I think we should have had bank failures in 2008. We should have had bankers and mortgage brokers who committed fraud go to prison. None of those problems were solved. And so, we're back to it where, because there's all this excess now, there's going to be a lot of the same stuff soon. So there's going to be a lot more fraud that's going to come out in the near future. I mean, we haven't quite seen to the levels of the mortgage crisis, the mortgage-backed security fraud and stuff like that. But I think, the longer this goes on before the next crisis, the more likely we are to see stuff like that.
No, I agree. And it doesn't take a lot of absolute amounts of mortgages or so forth to create the crisis, right? The crisis is created by the leverage in the mortgages or for today, for example, the leverage in corporate loans or in corporate bonds that are used to, purchase stock or whatever else they're used for, as opposed to really growing the corporations. It's those things that So the absolute number of them, the absolute value of them can crack, and that can create, as it did in the mortgage crisis, a much larger effect because of the sort of financialization of all of that kind of debt. And so that's what I think will happen next. Besides what can happen in terms of trade wars or geopolitics or sort of issues between and amongst countries, it's within countries, the fact that the trading and the restructuring of corporate debt and other kinds of debt is increasing in a way that the mortgage market did. That's where those problems can occur, whether there's like little teeny rate hikes along the way from any particular central bank, or whether there's, sort of bigger, whether it's corruption or whether it's geopolitics or whether it's just companies can't pay or service even their small amounts of debt, or whether it's debt that goes from interest to principal and all of a sudden they're stuck having to pay principal that they don't have the ability to repay. I mean, there's all sorts of ways that delinquencies and defaults can come into the market and therefore into structured projects which happened last time. So I agree, and I think central banks have really, and this is why they should be a much larger topic of conversation in the media and in governments in general, because they have, without any kind of restraint, and there's no regulations on central banks in terms of what they can do and what they can create. There's no voting. It's not democratic or republic in any sort of way. It's just literally a bunch of people who get to decide and who have decided to dump $21 trillion of fabricated money and then have it be leveraged in all sorts of potentially dangerous ways into the market.
Well, both political parties in the U.S., Nomi, have their spending projects, and so they don't necessarily want to raise taxes on everyone, so they would rather have the Federal Reserve give them the money for their spending projects, whatever those are. So,
well, this is why I think everything, this goes back to the beginning, this is why I think this can go on for a long time, because ultimately cheap money works for sort of some people and some elements in the government, and whether it's actually used for infrastructure or not, the availability of money being cheap is something that's attractive to a lot of sectors of, to the private world and the public world. And so even though it doesn't necessarily help the real economy or help real people, so it is attractive on that basis, and it's proliferated by a bunch of institutions and people that have no boundaries. And so that's one of the reasons why, even if we have these crises along the way, or even if we have some of these breaks, these plates falling along the way, there's still going to be this real pull of these institutions to try and continue to do what they're doing.
Yeah, I completely agree. I spoke about 4 or 5 years ago. I spoke off the record with a banking lobbyist here, and he told me straight up, fiat money is the cause of all this with the central banks, and he said there's not going to be any real change. This was after the 2008 financial crisis. He said there's not going to be any real change until another financial crisis and things get a lot worse. And he said then maybe there will be some real change. But there's a lot of vested interests that want the status quo to continue in one form or another. Very little changes, maybe tiny little changes around the margin or periphery. No real major changes, though. The fraud, though, there is some fraud. I forgot to mention this real quick. There is some subprime auto loan fraud. I'm not sure if it's at the levels, though, that we had, with the mortgage crisis, with the mortgage-backed securities, but it is over $1 trillion in subprime auto loans. So that is where they're knowingly giving loans out to people they know they can't pay. So the car companies can say they sold the car, and the people selling these high interest loans can make money off that. So at some point there's going to be problems there, and maybe people going to prison, hopefully, for giving out bad loans. But a couple more questions before we wrap up the interview. So what's your view then on blockchain technology? Do you think behind the scenes these central bankers are maybe discussing working together for a next system with like banning cashless society, and integrating blockchain technology into that for a cashless society?
I think on that, the central banks are aligned with the larger private banks, because the extent to which there's less cash in the society, but you still have the ability to sort of manipulate sort of currencies or buy bonds or infuse sort of the money into the system, you can sort of control how that's used and how that's spent, and how regular people have access to it, so that if you do have, for example, another financial crisis, you have the ability to sort of close ranks on cash or on people extracting cash, and have everything noted from both a data perspective, which is where the blockchain comes into effect, and just from a physically being able to take cash out of the system perspective, which sort of allows more control over, crises, or just in general the sort of influence or position that both the central banks and the private banks have in the system. So I think on that, that's not simply central banks. It's a combination of central banks and private banks, which is why I think they are very interested. I think blockchain has been added to a lot of the sort of global, sort of the G7 meetings, the things that happen in Jackson Hole, the things that happen in Davos. There's all sorts of agenda items that come into play at these meetings, and for the most part, they never used to include blockchain or crypto, but yet now it's part of every public, well, not really public to people, but I mean sort of every aggregated in the open kind of meeting, as well as conversations going on behind the scenes. And so I do think it's something that'll continue to be part of where central banks want to have influence and control, and not let it get away from them. But I also think it's as they've subsidized private banks, it's also a way to work with the private banking system on maintaining that control as well.
And a number of these larger central banks, including the People's Bank of China, are actually looking to hire, I think they've already hired a few, but hire additional cryptocurrency blockchain programmers, computer programmers who specialize in that.
That's right. I mean, the ECB has, I think you can look right now. I don't know if it's still up there, but I mean, you can actually apply for a job right now as a crypto programmer, I think. And in fact, there were some, I don't know when this was, but sort of recently, I know they were advertising for programmers and for sort of blockchain technicians and developers to as I forgot the wording exactly, but it was basically this is kind of a expanding job here, and you'll have sort of all this experience from our perspective versus the growth in this area, and it's kind of like a neat place to build a career and that kind of thing. So I mean, there's certainly a selling even of these jobs, these new jobs within central banks to people who can come and fill them in those areas.
I view this as worrisome and something to monitor because as someone who's a libertarian and likes free markets, I want options on what I can pay with. So I don't want a government telling me I have to use a debit card, and then if I put up this podcast, and YouTube's already probably going to demonetize this interview, but at some point, if there's a cashless society with blockchain, I mean, they could shut off my bank accounts for releasing an interview like this. I know China's talked about a social credit score or something, where if they don't like what you say in the Chinese government, they can deny you access to get on trains and planes there. So I hope that's not coming to the U.S., but it seems to me that I don't believe technology is inherently bad, good or evil, but I think it could be used for blockchain technology can be used for nefarious purposes in this case, where they would ban the ability to use cash or pay with other types of currency.
Well, yeah, I think it's also part of that ability to just sort of control the supply of money and who gets to it when and if it's needed for sort of the main players. And I think that it's another way to potentially do that. And so that's where that's where it's problematic if it's controlled by the same people versus it has more sort of a sort of democratic type of sharing.
So last question, Nomi. I've kept you for a little over 50 minutes. Talk about trade. Talk about maybe your view on the trade war. So we're seeing stories now almost daily of just back and forth between China and President Trump's administration of things escalating. I know you wrote a fictional book about the Great Depression in 1929. You've studied it. Is this reminding you of what happened with Smoot-Hawley, or do you think things are going to be a little bit different this time?
That's a really good question. I think it's very reminiscent of what happened. This whole period is reminiscent of what happened in the sort of 20s, sort of post-World War I U.S. isolationist kind of policies in the 20s that were combined with deregulation of the banks that ultimately culminated in the speculation that that caused the crash of 1929. But then the fixes for that, which was also caused by banks lying about the stuff they had and sort of selling it into the markets and people borrowing money to buy it and all that sort of thing, which is very similar to what we've seen in the last financial crisis. But also the remedy quote for that at the time was to have, from a U.S. perspective, was to enact certain tariffs as well in the beginning of the Depression to try and encourage, and this is reminiscent of language today, but people to sort of buy American and for American growth and so forth. But what they did instead ultimately was cause a Great Depression globally, because countries they simply couldn't necessarily cut each other off or pay each other's tariffs. So where there was growth in one area, let's say domestically for a country, there was a hardship in another area, and so net there was a major depression throughout the world. So what started as caused by a financial crisis, ultimately with the trade wars and sort of those sorts of remedies, I say also in air quotes, that were enacted to sort of deal with it, caused the Great Depression. The Great Depression caused a lot of negativity and hardships for people and sort of blaming of people rather than these policies throughout the world. And, that, for example, led to World War II. And so I do see that pattern in what's happening today. The difference could be that countries are more able to not deal with each other if they don't have to. So in my book, in Collusion, I talk about like the Chinese-U.S. relationship anyway, and how China has, even before President Trump and what's happening now with these trade wars, had been creating new relationships and stronger relationships and larger relationships with countries that had historically been U.S. trading partners, but sort of chipping away at the trade in general with the U.S. and just sort of getting a seat at that table. And those sorts of, Europe and Japan signed a historic trade agreement at the end of last year to do that. So there's been a lot of movement, which I kind of look at like hedging, like trading hedging instead of portfolio hedging amongst countries that could act as a barrier to a real depression caused from trade wars. But that's the difference today. The similarity is that they're happening.
And I think there's going to be a lot of collateral damage. If I've learned from studying Smoot-Hawley and how things escalated, there was the history of trade wars is normally back and forth. So there's one country responds to the other country's tariffs or denying them certain types of goods, and then there's a retaliation. It seems like it's almost kind of like a really bad tennis match.
I mean, and not to get biblical on this, but it's like that whole eye or whatever, but the eye for eye, the whole world goes blind, or wherever that's from. But it's that's kind of the idea. This whole tit for tat thing is the negative of it, and that is reminiscent of that period of history. And so, even with these broader relationships being built as a hedge to that, you still have the negative sort of diplomacy of trade wars that also can result in real wars, because all of a sudden the friends you used to trade with are like, well, you didn't want to buy our soybeans and you didn't want to buy our steel and you really whatever, and then all of a sudden they're not your ally anymore when you need them for other things, which is kind of also what happened in the run up to World War II. So it's kind of childish, really. It's kind of not looking at the bigger picture.
I think it reeks of desperation, and I think the main reason that this is happening, and you could chime in on this if you disagree with me, is that in the real economy, when you subtract the real inflation rate, GDP numbers are drastically overstated. Those are overstated intentionally so governments can continue to borrow more and more debt without paying higher and higher interest rates. Is that the global economic pie, Nomi, if the global economy was working properly, the global economic pie would be growing and there would be more pie to feed more people. So people wouldn't have to fight over a global economy, the analogy is the pie, that was shrinking. So they wouldn't be fighting over larger slices of a pie where the pie was shrinking. Instead, the pie would be growing. And in my opinion, the pie is not growing now, the pie is shrinking. And that's why you see, these really drastic measures like tariffs and trade wars and manipulating of currency and crazy mercantilist policies and things like that.
I agree with a lot of that. I'd add to that, though, that you also see sort of a lot of egos involved in terms of the timing of when these things are coming out and how they're coming out. These announcements on sort of all sides, and I think and the speed with which these sort of barbs of tariffs are exchanged. And I think so. There's also that level of it too. It's not simply economic retaliation.
It's not rational thinking. It's not rational thinking anymore. It's just like low blows. They're gonna just. It's just retaliation for retaliation's sake, like an emotional reaction now.
Well, yeah, and it doesn't seem to an extent, but it also doesn't seem to be having. Well, it doesn't have the longer term view or the impact of growing that pie. Like none of this is about growing that overall pie, right? So it's in that respect, the sort of knee-jerk reactions to each other's sort of tariffs is it's very reckless.
Well, I really enjoyed our discussion today, Nomi. I could obviously speak to you for hours, and hopefully you enjoyed the discussion today too. If our listeners, we have a pre-order code for your book.
Hey, Wall Street for Main Street fans. It's Mike the producer. This is where I jump in. You want to get 40% off Nomi Prins' latest book, Collusion? How Central Bankers Rigged the World? Well, you need to use our link at 800ceoread.com/Wall Street. That's 800ceoread.com/Wall Street for 40% off Nomi Prins' latest book, Collusion, How Central Bankers Rig the World.
Nomi Prins, thank you again for your time. I always enjoy the discussion.
So do I. Thank you so much, Jason.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone, despite YouTube censorship. And hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.